Hello, this is Steve Coker, president of Cedarstone Advisors, and this is the May edition of Cedarstone Economic Insights. In today's insight, we'd like to give you an insight on jobs. You may have seen that the March jobs report just announced came in weaker than expected. And in today's webinar, we'd like to cover why we believe it is likely temporary and that we see continued strong private sector growth. Lastly, I wanted to discuss this concept of middle-class wage stagnation. Is this real? Well, let's dig in. This chart shows both the household survey and the establishment survey for the monthly change in payrolls. Now, both statistics are numbers that you may see quoted in the news. And without getting into all the differences between the two measures, the key difference is that the household survey is much smaller and therefore much more volatile month to month. Nonetheless, you can see that the trend in both is rising and points to a gradual improvement in the job situation in the United States. Now, what has hit the news recently is this March dip you can see at the very end of the chart. Is this something that we should be concerned about? Well, if we dig into the March jobs report, where is the weakness? On this chart, we can see both the 12-month and 3-month job creation. Over the last 12-month period, job creation has been strong, but we did see several weak areas in the first quarter. The two areas that have shown contraction are oil and gas extraction and government. And the weakness in oil and gas areas, not surprising, and as you might expect, is related to the dramatic slowdown in energy investment, particularly drilling, due to the decline in oil prices. Now, the government sector downsizing is also not expected and is related to the contraction in Department of Defense spending. Notice that the best performing sector over the last 12 months, professional and business services, also had a comparatively weak quarter. Now, we believe that it's likely that the very bad East Coast weather had something to do with this weakness. The important takeaway here is that it doesn't look like the weakness is related to consumer spending, and all of the factors appear to be temporary. The big picture on jobs has been and will continue to be strength in the private sector jobs recovery, offset by weakness in the public sector. Even in the public sector, which includes federal, state, and local governments, we are seeing a bottom over a year ago, and most recently more sideways movement, probably showing a turning point even in the public sector. Lastly, I wanted to speak to the concept of wage stagnation. This is a battleground for politicians on both sides of the aisle. Is it really true? Well, when you take a look at the growth in average hourly earnings as shown on this chart, you can see that pre-recession wages grew at an average rate of 3.4%. Now, since the recession, wages have grown at an average rate of 2%. And so on the surface, it does look like wages are stagnating. However, what most of the pundits ignore is that real wages, meaning after inflation, have actually grown at a faster pace than before the recession. We have had extremely low inflation, shown here in black. And the real question we should ask ourselves is whether American workers have greater purchasing power. The answer to that is yes. And in fact, on a real basis, we see strong wage growth, which points to a continued recovery for the U.S. consumer and is a strong positive for the U.S. economy. I hope that this has helped put some of the more recent economic data into perspective. As always, if you have any questions, feel free to call anytime. And as a reminder, we have a rich library of content on our website at cedarstoneadvisors.com. Thank you so much for your time.